This is the SpaceX Rebound setup I am watching after 2026. Not because I think every dip should be bought, not because every rocket test is automatically bullish, and definitely not because a private market price target should be treated like a normal public stock chart. The thesis for this episode is very specific. If SpaceX gets through the next execution window, the market could eventually re-rate the equity toward a $300 per share scenario. But that only works if three things happen. First, Starship has to move from spectacular testing into repeatable transportation. Second, Starlink V3 has to become the capacity unlock that investors have been waiting for. Third, the valuation story has to shift from hype and scarcity to measurable infrastructure economics. That is the real technical analysis here. Not just candles, not just trend lines. A private market or newly public SpaceX chart is thin, noisy, and heavily narrative-driven. So I'm looking at a different kind of technical structure. Price history, valuation steps, operational catalysts, and the support levels that matter psychologically. Let's start with the hard anchor. According to Forge Global data, SpaceX has raised more than $10 billion of capital over its lifetime. Its historical primary rounds show a huge move in per-share financing prices over time. The 2002 Series A was priced at $1 per share. By 2015, the Series G was priced at $77.46. By 2020, the Series N was priced at $270 per share. That matters because a $300 level is not some random moonshot number. In old financing terms, it is only a modest step above the 2020 Series N primary price. But here is the catch. Forge does not currently show an evaluated live private market per share price for this request. That means I am not going to pretend there is a clean live quote. I am not going to pretend this is Apple or Nvidia with daily volume, standard moving averages, and a deep options chain. For SpaceX, the better question is this. What kind of evidence would make a $300 share scenario credible again? And that is where the chart starts to become interesting. The valuation path has been explosive. Forge Global lists a December 2024 tender offer valuation of $350 billion. It lists a December 2025 tender offer valuation of $800 billion. And it lists a February 2026 corporate round valuation of $1.25 trillion. That is not a normal valuation curve. That is a scarcity premium colliding with one of the biggest infrastructure stories in the world. When a company re-rates that fast, the next phase is usually messy. Early believers say the move is just beginning. Skeptics say the valuation already pulled forward too much of the future. And the stock, or the private secondary market, becomes trapped between those two stories. That is why I am not focused on whether SpaceX looks cheap today in a traditional sense. It probably does not look cheap by normal aerospace metrics. The real question is whether the next operating milestones can make the old valuation framework obsolete. The first milestone is Starship. SpaceX says Flight 13 is targeting deployment of 20 Starlink V3 satellites, a single Raptor relight in space, and another controlled entry, descent, and splashdown. Those three objectives are the heart of the investor thesis. The satellite deployment proves SpaceX can carry the next generation of Starlink hardware.
The Raptor relight proves the vehicle can perform controlled orbital operations, and the re-entry data proves the company is moving toward reuse instead of one-off spectacle. If those milestones begin stacking up, the market will stop treating Starship as a science project and start treating it as a logistics platform. That is the difference between a rocket story and an infrastructure story. Now connect that to Starlink V3. SpaceX says the V3 satellites are intended to greatly expand network capacity and user speeds. For the Flight 13 test, the planned V3 satellites are expected to extend solar arrays and antennas, attempt high-capacity laser links with the broader Starlink constellation, and then re-enter after deployment. That is not a full commercial deployment yet. But it is the first visible step toward a bigger idea. Starship becomes the delivery truck for Starlink's next capacity layer. This is why I think investors should watch Starship and Starlink together. If Starship works, Starlink can deploy heavier, more capable satellites at scale. If Starlink V3 works, SpaceX has a stronger reason to fly Starship frequently. And if both work together, the company starts building a flywheel. Lower launch cost, higher network capacity, better service, more revenue potential, more cash to fund the next launch system. That flywheel is the bull case. But the bear case is real. The bear case says the valuation already prices in too much perfection. It says Starship still has to prove reliability. It says a launch system that works occasionally is not the same thing as a transportation network. It says Starlink capacity can grow while margins still get pressured by capital intensity, competition, user pricing, and hardware costs. And it says a $300 share scenario is impossible unless SpaceX shows repeatable execution, not just dramatic ambition. That is why the next 12 to 18 months matter. For a technical setup, I would divide the thesis into 3 zones. Zone 1 is the reset zone. This is where investors stop chasing headlines and start demanding proof. In this zone, every abort, delay, or failed milestone matters more than the dream. That is where SpaceX is vulnerable. If the market is in reset mode, even good long-term news can be ignored because investors are focused on near-term risk. Zone 2 is the base-building zone. This is where the company begins to absorb bad news without breaking the thesis. Maybe there is an abort, but the next attempt happens quickly. Maybe a test does not complete everything, but the data improves. Maybe Starlink V3 is not fully commercial yet, but the deployment mechanics start to work. In a base-building zone, price action is less about euphoria and more about credibility. That is where I would expect serious investors to accumulate if they believe the long-term story. Zone 3 is the breakout zone. This is where the narrative changes from "Can SpaceX do it?" to "How big can this get?" For a $300 share scenario, SpaceX probably needs to enter that third zone. The market would need to see repeated Starship progress, clearer Starlink V3 economics, and evidence that the business model is scaling faster than the risk. That does not mean every test has to be perfect. In fact, perfection is the wrong standard. The right standard is iteration speed. Does the company learn quickly? Does it turn failures into design changes?
Does the next flight happen on a cadence that makes the system feel inevitable? That is the SpaceX advantage. The company's technical culture is not built around avoiding all failure. It is built around compressing the time between failure and improvement. If that loop stays intact, then the market can forgive volatility. If that loop breaks, the premium multiple becomes much harder to defend. So what would make me more bullish on the $300 scenario? First, a successful Starship mission that actually deploys Starlink V3 test satellites and collects useful heat shield data. Second, an in-space Raptor relight that validates the next phase of mission operations. Third, a visible increase in Starship cadence. Fourth, stronger evidence that Starlink V3 improves capacity without destroying unit economics. Fifth, investor communication that makes the valuation easier to underwrite, segment revenue, margins, CapEx intensity, and a clearer path to cash generation. If those things happen, then the $300 target becomes a story about operating leverage, not just enthusiasm. But what would break the thesis? Repeated engine start or relight issues, long gaps between tests, heat shield problems that delay reuse, weak Starlink economics, or a broader market that refuses to pay extreme multiples for long-duration growth. That is why I would not present this as a guaranteed rebound. I would present it as a conditional setup. If execution improves, if Starship becomes repeatable, and if Starlink V3 becomes the capacity unlock, then $300 per share becomes a serious scenario. If those conditions do not happen, the chart can stay stuck no matter how powerful the mission sounds. Here is my bottom line. SpaceX is not just a rocket company. It is a launch company, a satellite internet company, and potentially a space infrastructure platform. The market already understands the dream. What it needs after 2026 is proof. That is why the next phase is less about hype and more about confirmation. I am watching the $300 level not as a promise, but as a test. If SpaceX earns that level, it will probably be because Starship and Starlink V3 stop being separate stories and become one operating machine. And if that happens, the rebound will not be about one launch. It will be about the market realizing that SpaceX is building the infrastructure layer for everything that comes next. That is the bullish case, that is the risk, and that is the setup I am watching. This is research and analysis only, not personalized financial advice. Consult a qualified financial advisor before making investment decisions.